Thanks for tuning into Bloomberg Quint. My name is Neeraj Shah and you're watching Alpha Moguls, a series where we try and speak to some of the finest investing minds in the country and try and figure out how is it that they are gauging the investment climate currently. Our guest today, very special guest, Ravi Dharamshi, needs no introduction, but joins in with his thoughts on what the next 12 to 18 to 24 months could hold in store for every investor alike in India. Ravi, thanks so much for taking the time out and joining us.
Thank you, pleasure being here.
Thanks so much. What's the climate looking like? I mean, without getting into what levels and what valuations, so on and so forth, but if the last 12 months were prime for somebody who put money to work, can we have the next 12 to 24 months, if not alike, but still good enough for investors to make money?
Yeah, so definitely equities are not going away anytime soon. It's statistically speaking, we've been in a 8-9 year old bull run. We've seen really low volatility. So there is likely to be a big drawdown sometime in the next 6-12 months. I can't put my finger on it when, what is going to cause it, no idea, but that's going to happen. But the more pertinent question is, should that be looked at? Is that a reason I should be worried right now, or is that something I should be, looking at as an opportunity? Because finally, you need to figure out, is that going to be a correction and in which you should be investing, to generate returns over a 3-5 year period. So I am more from the camp that, yeah, there is going to be a drawdown for sure, because we have seen too low a volatility for too long. So, but I think that should be a good opportunity to invest.
If we speak to global investors, Ravi, almost all of them believe that while valuations may be rich in India and while there could be a correction which would be ideal, they do not foresee a reason which would make India correct in isolation. They believe that it would have to be an emerging market correction or a global market correction which leads India down. They don't foresee any local factors, and of course they didn't speak about the elections per se, but they don't foresee any local factors which can pull India down. Would that be a fair assessment, do you think?
Really, we shouldn't be worried about the factor, but okay, the genesis of this bull market is global. So, and we are part of a global bull market. It is not like we are rising in isolation. So definitely the pull out of money, if it is going to happen, it will most likely happen globally and will be part of the correction that happens globally. So we have had tremendous amount of liquidity being pumped in. There are first signs emerging of liquidity abating in US. Yet Japan and Europe still continue to pump in more liquidity. So on the margin, liquidity is abating. So that could be a reason for a correction at some point. But and we'll be part of that. I mean, if there are local reasons, that can only accentuate the situation. So I agree with that assessment.
Okay, one premise though, over the last 12 to 18 odd months also has been that the cost of equity, or maybe longer than that, the cost of equity has been so low that has driven participation, that has driven risk, and that is, well, simply put on an Excel sheet, your target prices would inch up higher, your PE multiples would inch up higher. Would that change now with all that's happening around the world, all that's happening in India as well? Would the next leg of growth for almost any company, any bottom-up story, be a question of earnings delivery alone, as opposed to it being a factor of earnings delivery come a PE re-rating? Has the re-rating story played out already?
I wouldn't say that. It has played out to a large extent in a lot of companies, but it's not like it has played out in every possible company. So just to give you an example, there are sectors bombed out sectors where stocks are down 50-60%. There are companies out there in real consumption, which is a secular theme, which is down 50% just like a couple of months back. So if you can find a good combination of company that is going through a tough times and where the improvement is happening on the balance sheet as well as in the P&L on the margin, then I think you can still get that PE re-rating as well as earnings growth from a next 3 to 5 year point of view. So I won't say that opportunities have dried up. They're fewer for sure.
Is that what you're looking out for as well currently? Because quite frankly, almost everything that is proven in terms of either earnings delivery or a story is priced to perfection or probably beyond perfection as well, according to most minds.
I definitely agree with that statement. there is a risk of valuations, especially where the story is identified and the company is, has been slotted as a leader in whatever it is. So you have to probably go down the curve a little bit, as in a balance sheet which is still repairable, and the improvement is, since, see, we are not in a expansionary phase, we are not in a boom phase yet. So if that boom phase was to come, it will benefit all the players, and probably this is a late stage, late cycle phenomena where those who have not improved will improve now. But the important point is that the improvement will figure in the numbers going forward. It's not yet happened. So there is a lot of comfort from that point of view, that this is not the perfect combination of high multiple, high profitability, which is unsustainable, and leverage, which is where I would get scared of putting money in equities. That's not the case at this point of time. It's only one of the things, which is the multiples are high because the earnings are low. And okay, there is some amount of frothiness in one or two sectors probably.
But you would presume that earnings, and again, I'm guessing you are at a liberty to speak about companies within your universe, but you would presume that earnings within your portfolio companies, if they haven't picked up already, would pick up enough steam in second half 18, maybe FY19, and possibly going beyond.
That's how we have positioned our portfolio. We have a few companies where the earnings growth is going to come now. It hasn't yet been happening for the last 2-3 quarters, and there has been some recognition of that fact. The variables are, the lead indicators are falling in place regarding growth coming back, or the costs falling, or the earnings growth coming back. So yeah, I would say that's how we have positioned ourselves, where the earnings growth is there in the next couple of years.
And are these bottom-up stories, or are these themes or sectors which by and large could actually see a growth in earnings revival?
So we would like to play it in a combination. Of course, we cannot place any bet unless we have done bottom-up work. But it has to be part of some thematic. And the more the tailwind from one or the other thematic, the better for us. I mean, you want to diversify in terms of it could be the move from financialization of savings, or whether it is a financial inclusion, or whether it is a digitization, or whether it is GST. So there are many real changes that have happened in our economy, and if more and more of those are providing tailwind to the sector or the company, the better. I mean, because you don't want to depend on one particular regulation, on one particular thing that is panning out in your favor. You want to be basically broad-based in terms of it being a long runway, 5-10 year runway, driven by multiple engines.
Okay, so interesting. I wanted to, you gave me ample opportunity to speak about one or two or three of these themes. Let's start off with this whole financial inclusion. Now, you would agree that it's something that almost everybody in the street now knows about, that let's play the financial inclusion themes. If not anything else, then the retail investor knows that this is happening because of the money that he's putting into mutual funds in a big way. So that is that first example of this whole financial inclusion theme. How would somebody play this theme now that 12 months onto demonetization has passed and people have seen some evidence of this theme already being played out, both in terms of actions being taken by investors, and two, in terms of the stock rewards that early cycle investors have already enjoyed?
Yeah, so there is a slight difference. The one is the financial inclusion, and the other is the financialization of the savings. What you spoke about is essentially financialization of the savings. But financial inclusion is basically led by Jan Dhan, Aadhaar, and mobile, where 30% of the population which was unbanked has suddenly come into the banking system. So, and more than their deposits, what I really care about is the products and the lending that the guys catering to them. They can have a long runway where they can witness a really big boom. So, for example, there are going to be 10 or 11 small finance bank listed over the course of next 2-3 year period, and their specific mandate is basically going to be cater to the lowest strata of the economy. So I think, and all these would be coming at a size of, let's say, anywhere between 500 crores book size to less than 10,000 crores kind of book size. And they have a long enough runway to grow at a 20, 25, 30% kind of CAGR. It's pretty equivalent to what you would have if you wanted to get onto the Kotak Bank in the late 90s.
Yes.
And you can see what has happened over a period of 10, 15, 20 years. Something like that can happen over here, because even after transitioning to a bank, these SFBs, their ROAs will trend somewhere between 2 and 2.5%. And the combination of that kind of ROA and a growth of 25-30% is a deadly combination for wealth creation.
True. Is this a runway for the next 5 years, or you would presume that the businesses are good enough to stay for, say, maybe a longer period of time?
At this point of time, there is clarity of 5 years, and we hope it stays beyond that also. But we have to keep reviewing what our stance is.
Okay. The other way to play this, and I think one of the themes that we spoke about earlier was the bottom of the pyramid. Now, do these themes tie in, financialization or financial inclusion, and companies catering to the bottom of the pyramid? So how does one play this? I don't want to get stock specific at all, but if you can give examples of themes of how does one play it.
So this is one thing that we said. This also, in fact, caters to the bottom of the pyramid, which is a small finance bank. The second such segment could be retail. If you see, in fact, right now we are witnessing a boom world over of retail, which is priced less than $10 or 10 pounds. Even in India, there are these retailers who are actually bringing those who are shopping on the high street. They are migrating to a more AC store, a large format store. I mean, which is organized, but not really, a mall or any such thing. It's just high street, but more organized.
Okay.
So there's a boom going on over there, because over a 3, 4, 5 year period, if you witness, these guys have been growing at 25% CAGR. Very few places where this kind of a growth is there. Again, this is catering to maybe not to the most bottommost strata of the pyramid, but just above that.
Yeah. And would this be falling within the apparel or the organized retail segment, or are you seeing this across different formats?
At this point of time, we are seeing it in apparel and organized retail more. But we will witness this everywhere, and combine this with the theme of generally a rural revival that is likely to happen. I think this theme will catch more and more steam going forward.
Okay. If I can just extend that argument to what would happen to consumer lending firms as well. Now, hitherto, these firms have been successful because of this rise of the urban borrower. We were speaking to Shanti Ekambaram of Kotak, and she was saying that until now, we've scratched, or rather, let's say, completely exploited the metro and tier 1, maybe tier 2 cities. A large portion of the country still remains unexplored, and that could be a big market as well. My question to you is how comfortable or how dependable would exploiting, or rather going into tier 3, tier 4 for consumer lenders be? And is that a theme that people like you or investors like you would bet on?
See, that's where the bulk of the India resides. Of course, urbanization is a theme, so more people are looking to come towards the urban centers. But increasingly, I was just talking to one of the retailer, and they were like, 5 years back, we used to think, top 5 metros and top other 10 tier 2 cities, tier 1 cities, and that's India. I mean, that's where it ends. But now increasingly, tier 3 and tier 4 towns are also where the potential lies. In fact, some of the tier 4 cities are doing businesses bigger than what tier 2 cities are doing. So really, there's a huge potential out there. We have no clue whether it will take 5 years or 10 years, but that's where the opportunity lies, and you have to be there. That's where the land grab is happening right now. You need to be targeting tier 4 towns today.
Okay. And what sectors do you think are doing that successfully aside of consumer lending? I mean, we spoke about how MFIs could be doing. There could be a branded apparel place. What about autos? What about white goods? Is that a pocket that is doing it, or will be successfully able to do it and generate volumes for those companies over the course of the next 5 years?
It's going to be visible across sectors sooner rather than later. Of course, each sector has its own enablers. For example, for consumer durable to pick up, you need electricity. Now, hopefully the electrification will enable more and more usage. Mobile phones, and the batteries hardly last, so you need to be able to charge them.
Yeah.
So that tells you that electricity is going to be available everywhere, and we are going to be more and more dependent on the consumer durables. And these are not luxury items anymore. These are part of the necessity. In fact, I think in the last round, a lot of them didn't get classified from 28 to 18%. In the second round, probably that's what is likely to happen. And you're right, the penetration will increase in all these consumer items going forward. I think we are finally reaching a stage of that inflection point where that consumption J curve finally kicks in.
Okay.
Yeah, I mean that we've been waiting for that since forever. But I think it's in the next decade for sure it's going to happen.
So you would believe, and I'm asking this question from a perspective of a retail investor who doesn't have the luxury of really going through all the balance sheets, all the P&Ls, but you would believe that this consumption story is still in the nascent years. It's not really played out completely, because you just mentioned the J-curve impact for consumption.
Not at all. It's not played out. So we might have witnessed one round of re-rating and in the stock market.
Yes.
But the actual consumption boom, maybe it will not be probably a uniform across the categories kind of a thing. Some sectors might start before, some might start later. But over the course of the next 5-10 years, each and every category is going to witness a huge boom, that is for sure. And stock returns, of course, there a lot more goes into consideration, when to buy, which is the company to buy. But from the thematic point of view, there's a long runway. There's no doubt about it. We are all hungry and aspirational.
Yeah, that's true. That's one thing for sure. Across the Indian landscape, for sure. Tier 3, Tier 4, name you what. Just one final question on this consumption theme. Autos, and a bunch of people are now starting to make this argument that if you can give a much higher valuation multiple to FMCG or consumption in that sense, why not autos, which are now starting to show almost dependable growth, are also a proxy for consumption in a way, and the businesses are looking strong and here to stay. My question to you is, one, whether or not you buy that argument, do you believe that the growth story in autos for the next few years could be a lot more secular as opposed to being, in a manner of speaking, cyclical?
So I don't agree with that statement that autos can get FMCG kind of valuations. Very simply because some of the risks that autos face, the FMCG companies do not face. See, even in the worst of time, an FMCG company would have never witnessed a 10% top line degrowth and a 20-30% kind of a price fall. The predictability of an FMCG versus an auto is far higher. Auto is cyclical in nature because it is capital intensive. It is a discretionary item. It is not a, it's not a staple item. And it is a capital intensive business as compared to FMCG. Hence, because of all these reasons, I mean, if you see an auto stock trading at FMCG multiples, then you should be selling out. I mean, I don't think that's going to happen. But that does not mean that it can have a 4-5 year period where they do tremendously well. But you have to be aware of the fact that those are not sustainable valuations. Okay,
we probably have an example or two at best, but those companies are just on a different plane completely. But let me ask you about the other part of the theme that we spoke about. We spoke about financial inclusion.
Yeah.
How about financialization of savings? Again, so let me rephrase myself. Financialization of savings is something that almost everybody is now kind of very, very comfortable with, knows about it. But the basket is really wide. BFSI as a basket is really, really wide.
Yes.
How does one play it here on?
So there are some fantastic financial distribution companies. There are some asset managers. There are some small banks that are going to cater to these savings. It has led to an improvement in the CASA for a lot of these banks. So there are many ways to play it, and in fact, I believe the intersection of financial and technology, which is the fintech space, will give rise to a lot of new winners, which we are not aware of at this point of time, which do not exist in the public domain. But see, the fact that we have an India stack and this Jan Dhan Aadhaar Mobile, essentially what government has done is basically created this pipeline, and you can push through, or whatever kind of products you can push through and reach a mass that is unprecedented in history. So the platform is available for any company to become large. These will be highly scalable models, but I'm yet not able to figure out. I mean, that's what I would be looking for. Which are the companies that would emerge as the, Indian version of the Square, let's say a payment solution company, or such companies in India. I think it's going to be a lot of wealth creation for sure. I need to identify and place my bets.
Okay. Let me rephrase. Let me put in part two of my question. A bunch of companies, which includes the diversified financial lenders and stroke the brokerage names. We've had one AMC getting listed, probably many more to follow as well. We've had a creation of a really large sector in insurance, and I think if HDFC Life is anything to go by, it's a bit of a revival post its listing and its gains as well. Within these tried and tested spaces, do you have a favorite in terms of a pocket?
No, so I have till now not bet on any IPO. Okay, HDFC IPO is great. Insurance is a space that I know I should have. It will become large enough, but I'm not comfortable with the valuations at this point of time. I think at this point of time in the supply chain, I would go with the shovel sellers, the product sellers, or the distribution companies. Those are the pockets where I see immediate and large gains, rather than the product companies, which might happen at some point in future.
Okay, somebody looking for 10-15% gains might even look at PSU banks, and we've heard a number of people who are satisfied with such gains come and say that the move is great, and the move is good. The question mark is what's the quantum of stock returns that it can get, and which is why I want to ask you, would you, as somebody who's looking to generate alpha on its portfolio, believe that PSU banks can do that? One or two large PSU banks, can they give you the alpha? Because the valuations, even after the move on 25th October, are nowhere sky high. They probably reverted to mean, but they are not really pricing in the positives if they do come in over the course of the next 12 to 24 months.
I agree with you. PSU banks do offer an opportunity in terms of generating stock returns. But for us, from an alpha generator, from a stock picker point of view, I do fail to see that change in the culture. I mean, if every 5 years we are going to have a different manager, but the same result, then there's no point in. And over a large period of time, they have not generated enough return on equity. So really, that's not investment worthy space as yet. But that doesn't mean there cannot be a mean reversion and stock returns. So that is, I would still categorize PSU bank in that space only. But there can be one or two banks, and for example, I mean, one PSU bank, Indian Bank, is one where it is showing signs of being ahead of the curve than everybody else in terms of improvement in asset quality. So maybe some amount of stock picking can be done, but again, we have not picked up anything.
Fair call. Have you picked up anything in the resurrection theme? And what I mean by this is companies which are now, I mean, when we started the conversation with repair balance sheet, or just show not necessarily a fractured balance sheet, but showing signs of earnings recovery due to various factors. Mid-cap IT is one such pocket. Maybe India exposed pharma is one such pocket, wherein valuations got beaten down to what was happening with the US exposed pharma too, but now people are probably distinguishing between the two. And I would probably throw in a third pocket there, real estate. The move in some of the real estate names, new names, not the old cycle names, have taken a lot of people by surprise.
Actually, in the balance sheet resurrection theme, in fact, IT and pharma don't feature over there.
Precisely, yeah, that's what I said.
They don't have a damaged balance sheet.
True.
What they have is a damaged P&L probably. On the other hand, real estate, definitely there is a balance sheet resurrection that is happening, or there is actually separation of wheat from the chaff. Whoever ended up, spoiling their balance sheet is out of the game for good. And with RERA and GST coming in, there is further crunching of supply. So I think it is a fertile ground, real estate, in terms of doing a stock picking, because from a longer term point of view, there is going to be wealth creation over here. There is some cleanup that has happened in the sector. I haven't yet placed any kind of a bet in real estate. We are more, our bets have been more on the ancillaries of a real estate boom rather than on the real estate developer itself. anything that goes into a house is what we have been focusing on, because that's purely because we like those business models. They are far more capital efficient than a real estate developer. But yeah, having said that, we actually picked up one balance sheet repair theme in a consumption stock. Yeah, so we are witnessing a revival of sort. So there is a lot of debt that was built onto the balance sheet that is getting repaid. The short-term headwinds have become tailwinds now. The raw material has come into the favor, and it remains a consumption. So for the last 4 or 5 years, there has been no growth in the industry, and going for the next 5 years, there is very highly likelihood that they'll grow somewhere between 10 and 15% at the top line. And with cost savings and with financial deleverage, the earnings growth can be 25 to 30%. So that, along with that, the fact that we are buying at a multiple of a subdued P&L, we should get re-rating as well as earnings growth over there.
Okay, so do watch out for those themes. But
yes,
the part 2 of my question, and which is why I qualified, not really balance sheet repair, but earnings cycle repair, mid-cap IT, select pharma, or a valuation repair in case of India exposed pharma.
Yeah.
Do you like those pockets?
No, definitely a space to look at, but it is going to be a case by case. I don't see in general revival of every sector, every stock in the pharma sector or every IT stock. So you have to be very picky and choosy about what you buy. In general, the valuations are way more reasonable now than they were in the past for pharma, and IT is a classic ignored sector for a long period of time. See, we downgraded the growth from, they used to grow at 25%, they came down to 15%, they came down to 8 to 10%, and sub 8% also. So no analyst is penciling in that the 15% plus kind of growth will come in. And these are very highly operating leverage models. So the moment the growth comes in, there is a possibility of re-rating as well as earnings growth. At this juncture, I think there's only valuation. I still don't see a trigger for the valuation re-rating to happen, but there's a lot of comfort in the valuations.
Okay, my last question, Ravi. Where are you anti-consensus?
Anti-consensus. Okay, for that I would have to know what the consensus is. No, but
okay, or let me rephrase. If not that, then what is it that you believe could be a big dark horse theme for not necessarily for the next 6-12 months, but something that you believe could be a dark horse for the next from a 24-month perspective? The story may not play out in the next 6 months, may start playing out post 6 months.
So just to be on the cautious side, I think NBFC is definitely one space that everybody has moved towards, and the kind of returns it has generated and the kind of positioning everybody is, it's definitely an area where if there are signs of trouble, then everybody is going to be rushing for the exits. Usually the case in financials that the problems emerge well later. The boom period has been 2014, 15, 16, 17 onwards. So somewhere in the next 2 to 3 years, the problems will emerge in the NBFC space. And I have no idea where, which segment, what will be the reasons why the problems will emerge. One needs to be very cautious investing in an NBFC right now from a 3-year point of view. So I would rather have a company or a sector where they're coming out of trouble rather than where they are already, witnessing boom times. That's broadly I would say an anti-consensus view that I have at this point of time. Otherwise, I think not many phases in, not many sectors in the country are witnessing a boom for me to be really worried.
Fair call. As we wind it down, I know you're a voracious reader. What's the best book that you've read in the last 6 months?
You know what, I just reread one of my classics, all-time good read, which is the Reminiscences of a Stock Operator. It's been my favorite, and I think every time you read it, you can learn a lot more. So I would recommend that. If you have not read that, you should read that.
Okay, fair call. That's a fair recommendation. We needed one recommendation from Ravi. He can't recommend stocks, so we got a book recommendation.
Thank you so much.
But Ravi, thank you so much for joining us on Alpha Moguls.
Thanks a lot.
And look forward to have you more often on this forum as well. And
thank you so much.
Thank you so much for tuning in today.